Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Westinghouse Airbrake Technologies Corporation Annual Report. Westinghouse Airbrake Technologies Corporation offers a wide range of products and services to the freight rail and passenger transit industries worldwide. The company operates in two segments, freight and transit. In terms of products, Westinghouse provides locomotives, engines, electric motors, and propulsion systems for various applications. This includes diesel-electric and liquid natural gas-powered locomotives, as well as marine and mining products. Additionally, the company offers a range of equipment and components such as freight car trucks, braking equipment, air compressors, HVAC systems, heat transfer components, and turbochargers. Westinghouse also provides various services to its customers, including locomotive overhauls, modernizations and refurbishment, locomotive and car maintenance, transit locomotive and car overhaul, unit exchange of locomotive components, long-term parts arrangements, and way equipment maintenance services. Furthermore, the company offers a range of solutions for railway and freight braking equipment, passenger information systems, signaling and railway electric relays, doors, window assemblies, accessibility lifts, ramps, and electric charging solutions. In addition to its core products and services, Westinghouse provides various digital solutions such as industrial/mobile Internet of Things hardware and software, edge-to-cloud, on- and off-board analytics and rules, and asset performance management solutions. The company also offers rail and shipper transportation management, port visibility and optimization solutions, and network optimization solutions. Overall, Westinghouse Airbrake Technologies Corporation is a leading provider of products and services to the freight rail and passenger transit industries worldwide, offering a comprehensive range of solutions for various applications. The stock price of Westinghouse Airbrake Technologies Corp., WABTEC, has seen a significant surge of over 36.69% in the past year, driven by a series of positive news events. The company's strong financial performance was a major contributor to this increase, with full-year adjusted earnings per share rising by nearly 19% and total sales reaching $11.17 billion, marking a 7.5% increase over the previous year. WABTEC's record multi-year backlog of $27 billion provides strong visibility and positions the company for sustained growth. The company's optimistic 2026 full-year guidance, projecting adjusted EPS to be between $10.05 and $10.45, further supports investor confidence. Additionally, WABTEC has increased shareholder returns through a higher quarterly dividend and expanded share buyback authorization. The acquisition of Dellner Couplers, a global leader in train connection systems, is expected to accelerate profitable growth and strengthen WABTEC's portfolio of critical passenger rail systems. The company has also secured significant orders and deals, including a $670 million deal with CSX to upgrade its fleet. Furthermore, the freight segment experienced significant growth in the fourth quarter of 2025, driven by higher locomotive deliveries and an increase in digital sales due to recent acquisitions. Overall, WABTEC's strong financial performance, strategic acquisitions, and robust future outlook have contributed to the company's stock price increase in the past year. Westinghouse Airbrake Technologies Corporation market capitalization of $44 billion is materially smaller than most of its industry peers of roughly $64 billion. Westinghouse Airbrake Technologies Corporation trades at a higher price-to-earnings ratio of 37 times and a higher price-to-book ratio of 3.92 times relative within the industry. This makes the stock appear much more overvalued compared to its peers. However, the broader industry is also trading at elevated valuation levels, suggesting sector-wide optimism rather than company-specific overvalue. Investor should evaluate if the stock is worth its premium price. The company maintains a moderate leverage profile, with liabilities making up 46% of total assets, suggesting a balanced approach between risk management and capital efficiency. Liabilities have grown faster than assets and equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. Shareholder equity has declined over the past 5 years, but operating income remains positive. The equity weakness may stem from capital structure changes such as buybacks or dividends rather than operational deterioration. The company has consistently reduced its share count, reflecting a shareholder-friendly approach to capital allocation. The income statement shows that the company have been growing its revenue annually and the operating income have been increasing. This shows that the business model works and the business is expanding. The primary drivers of revenue growth or decline in the rail industry are multifaceted and influenced by various factors. On one hand, revenue growth is driven by strategic acquisitions, organic growth, and increased investment in infrastructure improvements, digitalization, and automation. The growing demand for new technologies to improve safety, cost, and reliability of rail also contributes to revenue growth. Additionally, urbanization and growth in developing markets, sustainability and environmental awareness, investment in technology solutions, new locomotive orders, recurring revenue from service contracts, and expansion into new markets and regions all contribute to revenue growth. On the other hand, revenue decline is driven by industry fluctuations due to overall economic conditions and alternative modes of transportation. Fluctuations in demand due to changes in market drivers also lead to revenue decline. Inaccurate estimates regarding sales and backlog requirements, revenue obsolescence rates, customer attrition rates, and changes in macroeconomic conditions all contribute to revenue decline. Other factors that impact revenue growth or decline include foreign currency exchange rate fluctuations, interest rates, commodity prices, acquisitions, and antitrust lawsuits. These drivers highlight the complexities of the rail industry and the need for companies to adapt to changing market conditions to remain competitive. Net income at Wabtec increased by 23% from $22.27 billion to $27.41 billion between 2024 and 2025. This growth can be attributed to various factors, including a 10.2% increase in net income compared to the previous year, as well as a significant boost of $355 million due to acquisitions. The company's operating profit margin also saw an improvement from 15.6% in 2024 to 16.2% in 2025. However, not all aspects of Wabtec's financial performance were positive. Gross profit margins declined by 1.5 percentage points, primarily due to increased operating expenses as a percentage of sales. The company's gross margin decreased from 34.1% in 2024 to 33.5% in 2025. The reasons behind these changes are multifaceted. Wabtec attributes its growth to streamlined cost structures and operational excellence, as well as the acceleration of innovation in scalable technologies. However, global economic conditions have had a negative impact on business operations, leading to disruptions due to regional conflicts, unfavorable market conditions, and supply chain issues. In addition, increased operating costs from environmental regulations and restructuring costs have also affected Wabtec's financial performance. Despite these challenges, the company remains focused on driving continuous operational improvement and expanding high-margin recurring revenue streams through aftermarket sales. The company is indeed generating positive operating cash flow. This can be seen in the financial statements for both 2024 and 2025, where net cash provided by operating activities is reported to be $1,834 million and $1,759 million respectively. These figures indicate that the company has sufficient funds generated from its core operations to meet its financial obligations and invest in growth initiatives. The positive trend in operating cash flow suggests that the company's business model is generating sufficient revenue to cover its expenses, resulting in a net inflow of cash into the business. The company's debt level and interest expenses have undergone significant changes in recent years. One notable instance is the increase in interest expense by $24 million to $225 million, attributed to higher average overall debt balances, page 29. This trend continued with a substantial rise in net changes in debt from a decrease of $64 million in 2024 to an increase of $1,484 million in 2025, page 33. The company's long-term debt has also seen a significant increase, rising from $2,962 million to $3,701 million, page 36. This growth is accompanied by a substantial rise in interest payments, increasing from an unspecified amount in 2024 to $1,156 million in 2025, page 37. Furthermore, the current portion of long-term debt has increased by 150%, while long-term debt itself has risen by 23.6%, page 48. The impact on interest expense is evident, with a net increase from $201 million in 2024 to $225 million in 2025, page 49. Additionally, the company's interest payments have also seen an increase, rising from $181 million in 2024 to $219 million in 2025, page 67. The introduction of new debt issuances with varying interest rates has further contributed to these changes, including the issuance of 2030 notes at 4.9%, 2035 notes at 5.5%, and 2034 notes at 5.611%, page 73. Overall, the company's debt level and interest expenses have undergone significant transformations in recent years, driven by various factors such as increased long-term debt, higher interest payments, and new debt issuances with different interest rates. The company's financial performance varied across different segments and regions. The freight segment stood out as a strong performer, accounting for 72% of total net sales in 2025. This segment saw significant growth, with a balance at December 31, 2025, reaching $22,493 million, a 25% increase from the previous year. Furthermore, the company secured substantial new locomotive orders worth $2.2 billion. In contrast, the transit segment performed relatively poorly compared to freight, contributing only 28% of total net sales in 2025. However, it still experienced growth, with a balance at December 31, 2025, increasing by 14% from 2024. The company also signed new transit brake orders worth $140 million. While no specific segment was mentioned as underperforming, certain regions struggled. Russia and Kazakhstan were noted to have poor performance, although details were not provided in the summary. Management is emphasizing innovation and technology as key drivers for growth and improvement in customer safety and productivity. The company aims to reduce emissions through next-generation technologies and drive digital transformation in the rail industry. A focused growth strategy involves product innovation, new technologies, global expansion, aftermarket products and services, and strategic acquisitions. The company's outlook for the transit segment is strong, driven by increased demand for products and services, fleet expansion and renewals, and investments in sustainable infrastructure. With a global presence in over 50 countries and products found in more than 100 countries, Wabtec is well-positioned to capitalize on opportunities worldwide. To achieve accelerated growth, the company will prioritize operational efficiency through Integration 3 and portfolio optimization initiatives. This includes expanding high-margin recurring revenue streams, growing and refreshing the installed base, and driving efficiencies through emerging technologies. By leveraging its global presence and product portfolio, Wabtec is poised to increase revenues and margins through cost controls and improved efficiencies. Overall, management's strategy focuses on sustainability, innovation, and technology to drive growth and improve customer safety and productivity. The company's commitment to operational excellence and cost structure will enable it to achieve accelerated, profitable growth in the years ahead. The company has made several significant acquisitions and divestitures in recent years. Acquisitions have been a key part of the company's growth strategy, with notable purchases including Inspection Technologies for $1.788 billion, Frauscher for $792 million, Dellner Couplers for €890 million, Locomotive Kuristiru LKZ, for $111 million, and L&M Radiator, Inc., for $245 million. These acquisitions have expanded the company's capabilities and presence in various markets. In addition to these major purchases, the company also acquired Evidence Inspection Technologies Division on July 1, 2025. This acquisition is expected to further enhance the company's inspection technologies offerings. On the other hand, the company has also engaged in divestitures as part of its strategy. One notable example is the sale of certain receivables from originators through its revolving receivables program prior to January 1, 2025. Which generated up to $350 million in revenue. The company has a history of paying dividends to its shareholders. According to the financial reports, the company allocated significant amounts for dividend payments in recent years. In 2025, the company paid out $173 million, while in 2024, it was $140 million. The allocation for dividend payments in 2025 was even higher at $212 million. Furthermore, the trend of paying dividends continues as seen in the payment of $123 million in 2023. This demonstrates a commitment to returning value to shareholders through regular dividend payments. There are concerns about inventory buildup and supply chain disruption that could have a significant impact on the business. One potential issue is excess inventory if demand for products decreases below projected levels, page 12. Disruptions to the supply chain, whether due to regional conflicts, transportation issues, or raw material shortages, could also negatively affect operations, pages 13-16. The company has already experienced some of these disruptions, including orders being delayed or canceled and inventory buildup, totaling $144 million, pages 38-63. Furthermore, labor availability and sourcing challenges could lead to increased costs and decreased revenue, page 27. The company also maintains specific reserves for known inventory obsolescence or loss of customers with specific inventory, page 40. The financial impact of these disruptions is already being felt, with a $65 million charge related to changes in inventory due to increased raw material costs and tariffs, page 33. Overall, the potential risks associated with inventory buildup and supply chain disruption are significant and warrant careful consideration. That concludes the financial summary for Westinghouse Airbrake Technologies Corporation. Feel free to comment below, and I will be happy to answer them when possible.